Maybe you're starting to explore a career as an appraiser and want to know if now is the right time to get started. Or you're measuring your career span in decades and want to find out more about the latest apps, technology, and resources that can make your life and work a bit easier. Get the answers and insight you need with Beyond the Numbers, a podcast from McKissock Learning. I'm Julie Mohlendorp-Floyd, course and curriculum developer and instructor here at McKissock. Join me and an expert guest each week as we dive into the topics that matter most to appraisers, from industry and education news to marketing and other insights to help you run your business more effectively. If you'd like to stay at the forefront of appraisal news, boost your career, or just learn more about the profession, subscribe to Beyond the Numbers with McKissock Appraisal at Apple Podcasts, Spotify, or wherever you get your podcasts. Hope to see you there soon. Welcome to Beyond the Numbers with McKissock Appraisal. I'm your host, Julie Mohlendorp-Floyd, a certified general appraiser in Missouri and Kansas, and a course and curriculum developer and instructor for McKissock. As part of our special Toolkit series, we're talking about everything you might need to know when you're either getting started in the appraisal profession or when you're starting your own company. In this episode, we're covering S corporations and LLCs. What do they mean, and which one is the right choice for you? To help us understand, we're joined by Michael Potenza, CPA, JD, PE, and Senior Director of Instruction at one of McKissock's sister companies, Becker, a provider of education for certified public accountants. He's going to give us the lowdown on what an S Corp is, what an LLC is, and which one would be the right choice for you when you're setting up your appraisal company. Welcome, Michael. How are you today?
I am doing very well, Julie, and I want to thank you for inviting me to come and speak. I'm very, very excited, and I am a New York guy, so I'm going to try to speak slowly because I don't know if they could play this back at a slower speed, but we tend to talk really fast, but I'll try to keep it down.
That's all right. So let us have it. What is an S Corp? What is an LLC?
Well, that's a loaded question. There's a lot we need to really understand and digest to know what's best for us. So before I jump into it and give you the background and give you some advice on if you're going to form a business, do you go the LLC route? Do you go the S Corp route? Let me just make a little disclaimer. There are different rules for different states. So I'm going to do this from a more generalized perspective. But it is really important that when you make this decision for yourself, you understand the regulations of your state, the specific business landscape you want to start. So you might want to consult, and it's a good practice, with either your attorney or at least your tax advisor, because they may be able to provide specific information about your jurisdiction.
Great. Always check with a local tax advisor. Gotcha.
All right. So what I'm going to do is I'm going to first go through an S corporation, explain what it is, talk about the advantages and disadvantages of an S corporation. Then I'll do the same thing for an LLC, and then we'll try to wrap it up and give you some advice on what to consider when really making the selection. And I'll also need to talk about something else called BOIs. BOI, what's that?
BOI.
I'll tell you what that is, all right? So we'll get to that. So if that works for you, I could start right now with the S corporations.
Well, first thing, why can't you just operate as yourself? Why do you even need a business entity?
Great question. So you could, if you were a single person, you could just start running business yourself without forming any business, no problem, except you have unlimited personal liability. So the real reason you want to form either an LLC or an S corporation is you want to protect your personal assets. God forbid something happens and there's an accident or a lawsuit. You don't want them to not only take your business money and assets, you don't want them to take your personal assets, right? So that's why we do this.
Good point. Great. All right. So let's go. We do an S Corps first.
Mm-hmm. Okay. And keep this in mind when I do both S Corps and LLCs. The things we really need to focus on, what's the type of ownership for these entities and how do we manage them? What's the structure? And how do I distribute profits or losses if there are profits or losses? And big one, taxation. So I'm going to talk about all of those points for each of the two types of businesses.
Okay, great.
All right. So, first thing that we want to talk about with an S corporation is we've all heard the term corporation. Now, there's two types of corporations, an S corporation and a C corporation. Big, large, publicly traded companies, they're C corporations, and they pay double taxation. The
Oh,
corporation itself pays tax, and then when the dividends are distributed to shareholders, they pay tax on the same money twice. We don't want to do that as a small
no.
business, so we would not consider C corporation. But an S corporation, think small corporation. There's a lot of benefits. So the first benefit for an S corporation is very simple flow through, or what we call pass through taxation. In other words, you don't pay the tax on the same money twice. So the S
Okay.
corporation itself does not pay tax on the money. Rather, all the profits and losses and other items called separately stated items flow directly to the personal returns of the owners, the shareholders. Now, that's true for an S corp, and it's also going to be true for an LLC. So they do share that in common, this simple flow through taxation.
Okay.
But a big difference we're going to talk about between an S corp and an LLC. S corporations, when you're an owner and also an employee and you receive a salary, of course you're going to pay income tax on that, but you do not pay self-employment tax, because
Oh,
self-employment tax, as a corporation, you're not considered self-employed. But we'll learn when we talk about an LLC, all of the money that you earn through the LLC is subject to an additional tax known as self-employment tax. And I'll talk about that under the LLC portion.
great.
Next thing you want to think about is, let's say you form this business, it's doing great, you're running it for a few years. Then you say to yourself, you know what? I want to retire. I've done really well. So maybe I'm going to sell my business. Or maybe there's a number of shareholders, maybe 10, 20, 30 shareholders, and just one shareholder wants to sell their portion of the business. Well, if you
Okay.
form as an S corporation, shares are freely transferable. So it's much easier to sell your interest in the business as an S corporation than it is as an LLC. So we
Okay.
say with an S corporation, you can sell to whomever you want, whenever you want. All right. An LLC does not work that way.
Okay.
There is a special rule if you want it. If there's 5 or more shareholders who own more than 50% of the business, you can have what's called a closely held corporation, and you could build in something known as a right of first refusal. So if one shareholder wants to sell, the others have the right to refuse or to purchase it at fair market value. And let's get a little more into the weeds, but the general rule is for an S corporation, you can sell whenever you want to whomever you want.
Okay. Good to know.
And another thing when conducting business, you'd be surprised, but some people or some companies might hear, let's call it Appraisal Incorporated, but then they might hear Appraisal LLC if you form an LLC. And there's
Right.
some cachet or credibility to being a corporation as opposed to being an LLC. Now, in the real world, that's meaningless, but sometimes in the minds of certain businesses, they say,
Sure.
oh, you're just an LLC, you're not a corporation. So I always like to call that out to people as well. It's just kind of a perception.
It's an impression. Sure.
Mm-hmm. All right. Now, what are the disadvantages of an S corporation? Well, first thing is there are certain restrictions on the number and types of owners you can have. For an S corporation, you can have no more than 100 shareholders own the business. That's the max. However, let's say there's a husband, a wife, and a few of their children, 3 children, 5 of them who all own shares, they count as one shareholder because they're in
Okay.
a family. So when
Okay.
we say 100 shareholders, you could basically say even 100 families. And you have to be an individual. You have to be a U.S. citizen or a U.S. resident. You cannot have another corporation own shares in an S corporation, or a partnership or an LLC own shares in an S corporation. That's not
Okay.
allowed. And S corporations can have only one class of stock. Like C corporations, you can have common stock, preferred stock, different preferences for stock. Not for an S corporation. It's generally just one type of stock.
Okay. Most of our appraisal companies are going to be very small. They're
Mm-hmm.
going to be a lot of times there'll be one appraiser,
Mm-hmm.
uh, maybe two. So 100 shareholders, I don't think we'll have a lot of
There you
appraisal
go.
companies that run into that.
Okay, that makes sense. And the only thing to be aware of, another people think of as a disadvantage for an S corporation is the formality. See, with the corporation, the owners are called shareholders, but then those shareholders have to vote on and appoint directors. They sit on the board of directors and they set the business strategy. And then those directors in turn vote on and elect officers, the CEO and CFO and so forth. So technically, even in a small corporation, an S corp, you need to have shareholders, directors, and officers. Now, I myself have owned company as an S corporation with just me, one shareholder
Right.
who is the sole director and the sole president / CEO. So you
You're
can
the
absolutely do
CEO,
that.
CFO, president, you many
It's
different hats.
many hats, many hats, all good
Sounds
hats.
impressive.
Just not enough room on the business card. You don't want to put all
Right,
that stuff
right.
down, right? All right. So again, with the small company and especially one, two people, it's really not that big of a deal. All right. You just have to document it. That's all. It's just
Sure,
very simple
sure.
documentation. Now, the thing about an S corporation is, let's say you're running this business and it's successful and you never take a salary. Well, the IRS might not like that because they want payroll taxes, right? So there's
Okay,
payroll taxes involved. So if like when you just start up the business and it's, just new, you could get away with this. But after a while, they're going to look at how much money is this business making and, have you been paying yourself a reasonable salary because they want their payroll taxes. So when you say
okay,
reasonable salary, they'll look at the nature of the business, your role in the business, how much time you spend working in the business. They'll compare other businesses of your size in the industry, the financial condition of your business. Have you ever paid a salary yourself in prior years and then all of a sudden stopped paying yourself a salary? Because again, they want their payroll tax, which really comprises two main things: Social Security and Medicare. And if you don't pay
okay.
yourself a salary, they don't get their payroll taxes.
I understand. Yeah.
All right, so those are some highlights on advantages and disadvantages of an S corporation. Let me move into an LLC.
Okay,
Now, an LLC is looked at as being more flexible than an S corporation. It is less rigid. There's no
okay,
restrictions on the number of owners or the types of owners. And theoretically, an LLC could have a corporation as an owner. It could have a partnership as an owner. So you, again, have more flexibility. You're not limited like an S corporation with that 100 shareholders. But again,
okay.
I know in this particular space that we're dealing with, probably doesn't really come into play because it's only going to
True.
be one or two or three individuals. So it's no big deal.
Right.
Now, and when we talk about the owners of an LLC, they like to
Mm-hmm.
call themselves a special name. They like to call themselves members. Like, hey, I'm in a club. I'm a member. I'm an
Right.
owner of this LLC. Where owners of an S corporation are shareholders, right? But owners of an
Okay.
LLC are called members. All right, members.
Okay. Makes
All right.
sense.
Now, very easy to form an LLC. You don't have to worry about, okay, who are the shareholders? Who are the directors? Who are the officers, right? We don't have to worry about all of that.
No
And
elections.
that's right. And another thing with the S corporations, they technically have to have annual meetings. You have to keep minutes of those meetings. If some major change was to be done in the business, you have to have a resolution, a corporate resolution issued.
Okay.
So much more formal. But again, even with one person, it's very easy to do because you don't have to have a
Sure.
vote. You're the only one. So although it
Right.
sounds daunting, it's really not that bad.
I can have my own stockholder meeting in my living room
Or you could have your own stockholder meeting like
in
on the
Hawaii.
beach in Hawaii. Exactly.
Sure,
And that's
sure.
now a business expense, right? And that is
I
a
love
business
it.
expense. So yeah, that of course, that's one of the main reasons why you said, hey, Mike, why do we want to form an LLC or an S corp? And the big one I said was liability, right? You don't want you to
Sure.
risk your personal assets. But the other one, of course, are expenses, right? And writing off all of those business expenses. So that's really another, great feature of forming one of these types of businesses. And if you're going to have a
Hmm.
shareholder meeting on the beach in Hawaii, who am I to tell you not to, Julie?
Sounds good to me.
All right. Now, with an LLC, let's talk about management structure. See, with the
Okay.
corporation, it's very formal, right? Shareholders vote on and elect directors.
Mm-hmm.
They set the strategy. Directors have the officers run the business. With an LLC, you could have it run by the owners. We call that a member managed LLC. And you don't worry
Okay.
about any formalities. I'm an owner. I'm going to be running the business. But you could, if you wanted to, set it up as a manager managed LLC where you hire agents, employees to run the business for you. So you really
Okay.
have flexible options here. You could do it either way.
Right. I would think most appraisal firms would be member managed. We
I
don't
would
we don't
think
have
so
too many
too.
people. Yeah.
Exactly. And what's great about it is you can really tailor the management any way you want. And if you just say, hey, we just have our one or two owners, that's not a problem. They could just run everything themselves. It's not a big deal. It doesn't have the formalities of the S corporation.
Great.
Another nice thing about the LLC is how you can allocate profits and losses. See, with an S corporation, your profits, your losses are strictly allocated based on your percent ownership, based on the number of shares that you own out of the total shares issued. With an
Okay.
LLC, it's a little different. Like, let's say you and I are 50% owners in the LLC. It might
Mm-hmm.
be that you put up more of the money than I did. So we have an agreement that says, well, even though we're both 50% owners, Julie gets 75% of the profits. Mike only gets 25%. You could do it. It's very
Sounds good to
flexible.
me. I'm
There you
in.
go. However you'd like to do it. However you'd like to do it is good with me as well. Now, let's talk taxation. With
Okay.
LLCs, basically, if it's a one-person LLC, it's taxed like a general rule, a sole proprietorship, which basically means it's just as if you were an individual running a business. Everything will flow through directly to your personal return. If you
Okay.
have more than one owner, it's taxed like a partnership. And what that basically means is you would take all of the profit or loss. Let's say, again, you and I were 50% owners each, and we made $100,000, profit. Well,
Okay.
assuming we split it evenly based on our percent ownership, we would have each what's called a Schedule K1. And that K1 would have 50% of all of the profit or loss for me. And then you get your own K1 with 50% of the profit or loss for you.
Okay.
All right. Now, again, if you do have more than one person and you're going to have a female, you might even want to set it up where you have females who are more than 50% owners, and they could be designated as WBEs, women-based enterprises, because some contracts, maybe government contracts, they will allocate a certain percentage as being required to go to WBEs as opposed to just a general LLC. So there are other little things. And again, that's
Other
where you may want to talk
benefits.
to your attorney or your tax advisor to see certain advantages of doing that.
Sure. Sure.
Okay, so you get your K1. It's going to have all your profits and losses that are specifically allocated to you. And there's other little things on there called separately stated items, where if the business has interest income or dividend income or a charitable deduction, it all flows to your personal return through this K1. But
Okay.
the good news is no double taxation, right? And that's
Love
what we're
it.
always looking for.
Yeah. We want to
All right.
avoid that when we can.
Absolutely. Now, you've been running this LLC for a while and you want to retire, you want to sell it. If it's just you by yourself, no problem. You can sell it whenever you want to whomever you want. But technically, if there's more than one owner in an LLC, you need to get unanimous consent of the other owners of
Okay.
giving permission to sell it to a particular party.
Mm-hmm.
Now, you could change that in your operating agreement. Your operating agreement tells you how you're going to run the business, but unless you change it in there, you really need a unanimous consent of all the other members before you have permission to sell it to whomever you would like to sell it to.
That makes sense.
Yeah. Now, we don't have that in an S corporation. You have it in an LLC, but you could change that in your operating agreement.
Okay.
Now, the biggest disadvantage of the LLC over the S corp are self-employment taxes. Now, as you work for an LLC as a member owner, you are going to be considered self-employed. So what this tax is, and everybody pays payroll taxes, right?
Sure.
So if you're not self-employed, as a person who gets a wage from a company that I work for, 7.65% of my salary is going to go to Social Security and Medicare. But my
Right.
company matches 7.65% as well. So in total, if I pay 7.65 as an employee and my company pays 7.65% of my salary to Medicare and Social Security, add them up, that's 15.3%.
Ooh.
If you're self-employed, there's no company, it's just you. So you pay the entire 15.3%.
You pay both. Okay.
You pay both shares of that. So
That's
what
not
that
fun.
means is if you're an LLC, you have to be aware that you're going to pay an additional 7.65% to your payroll tax, to your Social Security and Medicare. Now,
Okay.
we could really get technical where the Social Security is only on your first $160,000, but your Medicare is on all your salary. But here's what it really translates into. Ballpark round numbers. it could be if you make a salary of $160,000 or more, you're going to pay an additional $10,000 in self-employment tax that you would not be paying under an S corporation.
Okay.
So you really have to look, well, how much money is a company going to make? What's my salary? And then, run the numbers both way as an S corp and as an LLC, and see if it's significant enough that, you would rather choose the S corp over the LLC.
Okay.
All right.
Wow.
Yeah, that's a lot. Take a deep breath here.
That's a lot.
That's a lot. All right. So before I even kind of do a little wrap up here, Julie, questions. What do you have for me so far?
So I am a one-man appraiser shop, one-person appraiser shop. I want to set up my appraisal company. I've previously worked for a large firm, and I'm going out on my own. It's just me. I work from home. I'm successful, but I'm not blowing it out of the water here. I'm not making $1 million a year. I have my home office. I have my driving, my vehicle, driving to and from appraisals, that kind of situation. Which one's right for me?
It's a great question. And again, I'm going to give you the generalized answer.
Sure.
You really need to check our state regulations, right?
Of course.
Okay. Both have no personal liability, right? You're protected. So you're good in both cases.
Okay.
Both have simple flow through taxation, easy taxation. So you're good there. The big difference is S corporation is more formal, LLC is less formal. But to me, a big difference is that self-employment tax piece.
Sure.
As an S corporation, I'm not paying self-employment. So if you think you're making around, let's call it $100,000,
sure.
I mean, that could be an extra $5,000 a year in tax you may have to pay as an LLC under self-employment taxation that you're not going to have to pay as an S corporation.
Okay.
So me personally, I own a few different businesses. I have them all set up as S corporations. I find because although the formalities are there, it's very easy because I am the shareholder, director, and the officer. I have my meetings and I make, one paragraph I write every year. It's a boilerplate. I copy and paste it and I change the dates basically, and I keep my records on it. But I'm trying to save as much money as possible. So that's why I myself tend to move towards the S corporation over the LLC.
Interesting.
Yep. Now, if you did want to have other corporations or partnerships as owners, or you were going to be much bigger, then the LLC is going to be the way that you're going to want to go because you have less restrictions on ownerships than the S corporations. But going by your model that, hey, I'm just, one or two or three people, I really think that the S corporation will, in the long run, save you money over time.
Okay. So that makes perfect sense. And I'm much clearer on what the difference is between the two, the good and the bad. Now, you said there's one more thing we need to be sure we cover. That's this BOI. Tell us more about that.
Okay, BOI, it stands for Beneficial Ownership Information. And there was a law passed by Congress in 2021 called the Corporate Transparency Act. And this was a bipartisan act. Both Democrats and Republicans voted and approved this. And what it really is every business outside of like publicly traded companies and very large companies, because we know who owns them, but every business, and really this is small, mid-sized businesses, they need to register every year stating who the owners are and who's running the business. And you may say, well, Mike, there are a lot of small businesses in this country. Why do they really care and have to report every year who are the owners, who's running the business? And it really comes down to two words: money laundering. Money laundering. Right? What's that?
Okay.
Are you serious? Well, yeah. You see, what happens is, listen, we know there are people that do illegal things, right? And one of the things with these illegal acts, they get a lot of ill-gotten money, right? Illegal gains. So they have to wash it. They have to launder it. And they set up these small businesses and shell companies, and they put the money through it, making it look like they're legitimate businesses so that they can then have this clean money. So there is an area of the Justice Department known as the Financial Crimes Enforcement Network. It's known as FinCEN, FINCEN. So
Okay.
they really govern the registration. You just have to go to www.fincen.gov/BOI, beneficial ownership information, fincen.gov/BOI. And it's very simple. It takes you 5 minutes to really register and put this information in. But if you don't do it, there are very heavy monetary penalties and even jail time if it's long enough. So it's no joke. So you really need to make sure if you form your business that you register on the FinCEN website.
Great. That is good to know. All right. So wrapping up, any last nuggets of wisdom you would like to leave us with, Michael?
I'll just say, listen, I've been a small business owner for many, many years and run businesses, and it's extremely rewarding, as I'm sure everyone in your company, in your industry appraisal, will feel the same. And you come from a big company, you start your own little company, it's scary. But at the same time, it is so rewarding once it is successful. So set it up right, and you'll save yourself a lot of headaches and aggravations over time. So that's why I always say, talk to that tax advisor, talk to that attorney, make sure you set it up properly.
Right. Better to prepare than to have to react later on. Great.
Exactly.
All right. So thank you again, Michael, for being here today. And thank you all for listening to Beyond the Numbers with McKissock Appraisal. Much appreciation to Michael Potenza, our guest today, the Senior Director of Instruction at Becker. And be sure to rate, review, and subscribe to our podcast anywhere you get your podcast information. And join us next week where we'll be talking about going paperless in your appraisal office. Do you still need a printer? We'll talk about it and you can make that decision. You won't want to miss it. Thanks for tuning in to this week's Beyond the Numbers. If you'd like to stay at the forefront of appraisal news, boost your career, or just learn more about the profession, be sure to subscribe to Beyond the Numbers with McKissock Appraisal at Apple Podcasts, Spotify, or wherever you get your podcasts. Thanks for stopping by.